Hi guys, here Devang Maheshwari from equialpha.com. In this video, we'll discuss about how to make your investment a process-based investment methodology so that whenever you see upon some stock, you know what questions to ask for. Before moving to that, let me tell you about one great legendary Wall Street investor, Peter Lynch. Peter Lynch is one of the greatest growth investor. Also, the author of the book One Up the Wall Street. If you have not read that book, I highly recommend you to read that book. It's total wisdom. Also, he has a record of making 2800% returns in a span of just 13 years. I mean, that's huge. Let's see what does Peter Lynch has to say about investing and why investing is simple if you have all the things in your place. So, let me welcome you to Peter Lynch. Hi Peter, what do you think about investing? There are a lot of misconceptions and stories around investing, but we want to hear from you that what do you think about investing, and is that simple or is that very tough?
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it. Don't worry about it. Don't panic.
That's it? Are you serious, Peter? This is like one of the biggest advice that I've ever heard. You're saying that you don't need any education, all you need is some patience, little research, and no panicking? I'm hearing it right? Or is that only you who can hear it? Yes, it is right. Before that, I want to say I really wish if that was a real interview part. Yes, that's it. If you know what questions to ask for. Yes, it's simple if you know what things you need to exactly look for. Yes, if you know what things you need to avoid for. Now look at it from this angle, that you know what things you need to look, what things you need to avoid, and what are exactly the things of high importance. And when you have all these answers, bang on, you're ahead of 95% of the people around, because nobody takes that much of pain to understand these things. But I know since you are watching this video, you are curious to learn what are these things, what are the things that I need to avoid, and how to make an investment statement that clearly depicts and acts like a checklist for you, so that whenever you see some stock, you just need to go through it, and if it's fulfilling that, you need to buy, and if it's not, let's throw it out. A plan that will help you whenever you will feel confused. You don't need to ask to anybody else, you just need to follow those steps. So I don't know about what your investment plan is, but I know what my investment plan is. So I'll tell you how I break up the fundamental analysis into a 5-step process framework, so that I'm never in confusion. The first thing that you need to look for whenever you are understanding a company and doing a fundamental analysis of it is the growth part. Second comes in about the management. The third comes upon the financial health. The fourth comes about the profitability, and the last comes upon the valuation part. If these 5 things are fulfilling for me and are working in the right direction, bang on, I have a stock to buy for. And if any one of this is not fulfilling up, it's a stock to be crushed for. Now, what are the questions that you need to ask for each and every step? You need to write these questions on a piece of paper, so that whenever now you're looking at any stock, you don't need any external consultations. You can do it by your own. Now we look onto each and every step of what are the questions that you need to ask for, and write down those questions. Also, please don't forget to subscribe and like this channel if you like the video. The first part is of the growth part. When I say growth, it includes both the profit growth and the sales growth. But why profit growth is important? Because in the long term, the stock market history says that profit growth and share price growth, they are in direct correlation and are directly proportional. So if your company is not growing up your profits, it's not growing up your sales, then don't expect the share price to move in your direction. With regard to company sales growth, also look onto the industry sales growth, look onto the industry profitability, that whether the industry is growing at a good rate or not. The industry should not be stagnant. So the questions to ask here specifically is the company's sales growing? Is the company's profit growing? Is the industry overall growing? That's the importance of these 3 questions. And why is that important? I told you, because price will mirror up the profits in a longer term. The second part is of the management. For example, if you're taking any services from any of your local areas or maybe online, and if you find some negative information or some negative reviews about that person, that that person has done a fraud previously or that person was in jail 2 years back, will you still consider doing a business with him, or will you still consider buying some product with him? A genuine question that will arise in your mind is that, will the services be genuine? Is the product that you are thinking to buy will be genuine? There might be a case that it's fraud. The product that you get is bad. That's why we never like in working with people who are unethical or who have a history of frauds. That's what you need to know for management also. The question to ask specifically here is, the management ethical? Are there any fraud cases against management? For example, some SEBI penalty or some insider trading, or they might be in a jail for some time, maybe 5 years back, 8 years back, or there is any other negative news about the person who is running up the company. And why is that important? Understand that if the promoter itself is not genuine and he is not ethical, how do you expect him to be ethical towards you? Why should he care about your money? Why should he care about your growth? That's what the importance of management is. And once you find some cases against him, then you cannot trust anything with regard to that company. You cannot trust any profit growth. You cannot trust any valuation part. Nothing. All the financial statements, they are just pieces of paper that have no meaning if the person who's making it, who are running the show, are poor in mind. The third step in the fundamental analysis framework is of financial health. Financial health, what's that? Basically, financial health tells you the efficiency of the business. It tells you how solid is the foundation of business. If the business is of not solid foundations, what will happen? For example, you are making a building and that building's foundation is not good. How many floors are onto it doesn't matter now. Because if there is some problem, the entire building will collapse. The first floor will also collapse and the 13th floor will also collapse. That's how important foundations are with regard to anything that have in existence. That's what apply to business also. Just growth is not sufficient. The growth should be on solid foundations. And when I say that, what does I mean specifically? What I mean is, you need to understand the efficiency ratios of the company and also the solvency part of the company, which specifically will include how's the debt equity ratio of the company. Is the company taking huge debts? How is the inventory turnover of the company? Is the company making enough rotations with regard to its inventory? Receivable turnover ratio, how efficiently the company is able to collect its money back from the customers. So these are the questions that you need to ask from a financial health perspective. The debt equities, the receivables, inventories, and all other things that tell you about the efficiency, which might include fixed asset turnover also. These are basically deep dive into the ratios of the company that will give you how solid the foundations and efficiency of the company is. The fourth part in the fundamental framework is about the profitability. Just the profit growth is not enough. You need to see about how efficiently the company is generating money on its capital. Yes, I repeat, on its capital. Majority of the people around doesn't look onto this. They see that okay, the company is making profits, so it's good. Yeah, it's good, but not the good case for an investment. Come on, you can't invest in every company around. You need the best of the companies to invest into it. That's why you need to look upon specifically what is the return on capital employed, what is the return on equity of the company, how sustainable these returns are over the years. Are they in a growing trend? Are they in a downward trend? Once you know about that, you know that the company is efficiently using the capital. By this I don't mean the profit figure, that whether the profit figure is positive or negative. That is just a figure. On what thing that figure is to be calculated is the return on capital employed, return on equity. Also, the free cash flows that the company is generating. Because just profit is not sufficient. We need real cash, right? Real cash to pay salaries, real cash to pay up the rentals. How efficiently the company is managing its cash flows. That's the importance of financial health. You need to think from an equity shareholder point of view. That's what's the return to me. That is return to equity. What's the return capital employed? What's the return to the assets that company have put? If you don't know about how to use up these ratios, like return on capital employed, return to equity, return on assets, I have already made a video on this. The link is on the cards. You can go and look up onto there. The fifth part is about the valuation part. If everything in 4 is good, but the valuation is overvalued, it will not be like this. It will be scattered around, and in that manner, you will not be able to make money because everything good is already into the price by that time. For example, you're playing a football match. Every person in a football team has its own role, from the goalkeeper to the defender to the person who is in the attack mode. Similarly, in a cricket also, you have bowlers, you have batsmen, you have fielders, you have wicket keeper. What do you think if your team is made in which there is no batsman or all are the poor batsmen? What do you think a team who has no good bowlers around? Do you expect that the team will win? Definitely no. That's why here also all these 5 things need to work in sync in your favor so that you earn money, and that's how you should start looking at thinking when you're seeing at any stock or any company. For example, if a company is having very good sales growth but the financial health of the company, that's the foundation of the company, debt equity, it's very high, that it simply means that the growth is funded by outsiders money. How long you will survive by using outsider money? Can you survive in your own on some outside money? Similarly, a company in long term cannot survive on outside money forever, and that's why it's a problem. Now imagine you have all these questions written on a sheet of paper, and whenever you are analyzing any company, you are just making a tick mark on that whether it's fulfilling or not. Investment done. Now, if you find this interesting and want to know more about each and every step, then you need to show me your interest by commenting below that yes, I want to know more, so that I'll make a video on all these steps. Hope you find this video interesting, and if yes, please do subscribe, like and click the bell icon. See you guys.